Welcome back to the deep dive. So you sent us the Q3 2025 earnings call from one of the real giants in connected
A
TV.
beer titan, yeah.
And our mission today, well, it's pretty clear. We're going to cut through some of that corporate speak and figure out exactly how this big platform plans to keep up that double-digit revenue growth.
While also boosting profits.
Yeah, into
Exactly.
2026 and beyond. It's quite a goal they've set.
It really is.
And look, it's a fascinating snapshot. This company is hitting, real maturity. They're not just about selling the hardware anymore.
Yeah.
Now it's all about managing capital smartly and really, really focusing on monetization. And just before we even get into the strategies, that financial base they have, it's huge.
Okay.
They're sitting on $2.3 billion in cash and short-term investments.
That's a serious cushion. And the numbers themselves, they're finally showing the profitability everyone's been waiting for, which feels, well, key. It's absolutely key. And what's really interesting here is Q3. That marks the first time since, fiscal 2021?
Yeah.
That they actually hit positive operating income.
That's a big milestone.
Huge. And looking forward, their Q4 outlook. It's their highest ever adjusted EBITDA forecast. We're talking $145 million.
Wow.
So yeah, they've definitely crossed that line into consistent high-level profitability.
Okay, so that completely changes the story, right? They're moving from just pure growth to like a capital-efficient machine.
Exactly.
And you see that pivot in how they're handling their stock too, right? This focus on dilution management. They bought back $500 million in stock just in Q3.
500 million. Yeah, that's a real signal to the market. It says, we think our stock's a good buy, and it shows, operational maturity.
Yeah.
Their long-term aim, they say, is to offset 100% of share dilution over time. Basically, they're saying, look, we're generating serious cash flow, and we're going to use it to reward shareholders and reinvest smartly. This isn't some company scrambling for cash anymore. This is a company that feels like it's in control of its own growth story.
Okay, so let's unpack that growth story itself. The CEO laid out, 3 specific areas, kind of interconnected strategies meant to drive platform revenue and keep things humming.
Yeah, a three-pronged approach, really, all focused on making the most of their main asset.
Which are?
Okay, number 1, making better use of the home screen experience. 2, really growing ad demand, especially through performance marketing. And 3, expanding subscription revenue and finding new verticals.
Got it.
Let's start with the home screen, because honestly, that's the linchpin for everything else.
Okay, so why is the home screen something we probably all just click past? Why is that such a huge strategic asset?
Well, it really boils down to scale
Mm-hmm.
and the behavior it drives,
Okay.
I mean, we're talking about a platform that's in half of all broadband homes in the U.S. It's the first thing you see.
Right, the starting point.
Exactly. When you fire up the TV, that screen, that's like the most valuable real estate in the whole CTV world.
Mm.
It's the gateway to finding stuff. And crucially for them, the gateway to, making money.
And we've seen them tweaking it, right? Like that recommendation row they added not long ago. Apparently that's working.
Seems to be, yeah.
Yeah.
Continuous little improvements.
Yeah.
But the really big one, the potential money spinner,
Yeah.
is this major home screen overhaul they're testing now, planned for 2026.
Okay, the big update.
Exactly. And this is where, the tech meets the money strategy. They've got 2 goals for this 2026 update. And honestly, they're kind of tough to balance.
Which are?
Goal 1, keep or even improve that simple, easy, delightful user experience people like. It's iconic for being simple.
Right, don't mess with what works too much. And goal 2 must be the monetization piece.
That's where the cash register rings, precisely.
Mm-hmm.
That's also drive more engagement and monetization.
Yeah.
So the design needs to subtly nudge you towards, say, signing up for more subscriptions or maybe watching more of their own ad-supported stuff. And they claim the testing is going well, showing they can actually hit both. Keep users happy and boost engagement, which for them means better ad inventory.
Okay, so optimize the front door, keep people happy, get them watching more. That flows right into pillar number 2 then. Boosting the ad engine, focusing on performance marketing.
Yep.
Their whole approach here seems to be about being open and interoperable. Like they want to integrate deeply with all the big demand-side platforms, the DSPs.
Yeah, and that's a really critical strategic choice. They're not building a classic walled garden. They want to be the connector in the middle,
Yeah.
meeting advertisers where they already are.
Makes sense.
The big news this quarter was really deepening that Amazon DSP integration.
Now that's interesting. Amazon's a partner, but also a huge competitor in streaming. What does that integration actually do?
Oh, it's massive. It just opens the floodgates to a whole new pool of advertiser money that Amazon controls. It literally just turned on, so it's early days.
Yeah.
But they're saying customer interest is strong already, and they expect it to really ramp up through 2026. Basically, if you advertise on Amazon, now you get seamless access to this platform's inventory and data too.
And that probably puts pressure on competitors as well.
For sure. It reinforces their position as kind of the essential distribution channel.
And it's all geared towards efficiency for advertisers, not just throwing ads out there. We saw that with the measurement stuff too, like apps flyer integration. But I think the detail that really jumped out at me in the ad strategy was about their self-serve platform, Ads Manager, for the small and medium businesses, the SMBs.
Ah, yes, Ads Manager. This is their big play against, the Meta and Google dominance in performance ads. That self-serve market, it's potentially enormous, billions. And historically, CTV hasn't really cracked it.
Right.
And the Q3 stat they shared was pretty wild. Something like 90% of the advertisers using Ads Manager were totally new to the platform.
90%. Wow.
Yeah. It means they're successfully pulling in a whole different type of advertiser. The ones focused purely on measurable results, ROI, not just brand awareness.
So they're basically betting they can become the most effective, the most performant CTV platform out there. What makes them think they can challenge the big online players?
Well, it seems to be three things working together: scale, data, and new tech. They have the scale, right? Half the U.S. They have the viewing data, first-party data, which is gold.
Okay.
But the tech piece, specifically plugging generative AI into the ad system, that could be the real game changer, especially for those smaller businesses.
Let's dig into that AI bit. How exactly does AI help, say, a local pizza shop advertise on TV? That always seemed super complicated and expensive.
Exactly. It tackles the cost and the complexity of actually making the ad. Traditionally, a TV ad meant hiring a production crew, maybe an agency, waiting weeks.
Yeah, big barrier.
What they're rolling out are tools where that pizza shop owner can basically type in their offer, click a button, and the AI generates a professional-looking video ad for free, instantly.
Seriously,
One click.
that's the promise. It makes video ads on TV suddenly as easy and fast as setting up a Facebook or Google search campaign. And that's a direct challenge to the SMB dominance those older platforms have had for years.
Okay, that is potentially disruptive.
Yeah.
Right, so optimized home screen, supercharged ad engine with AI and partnerships. What's the final piece? Pillar 3, subscriptions and new verticals.
Right. This is about locking in that steady, recurring revenue. The traditional premium subscription side, they say it's healthy, and more big Tier 1 services are coming in 2026.
Okay.
But they're also building out their own services, their owned and operated stuff, or O&O, using their scale to launch really specific content plays.
Like that Howdy service they just launched.
Exactly like Howdy. It's their own subscription, video on demand, SVOD, only like $3 a month, no ads. And it's aimed squarely at a big market segment they think is underserved right now by the mainstreamers.
They can use all that viewing data they have to spot these niche audiences with high potential value and then just build content for them. They think this could become a pretty significant business over time, kind of like their free ad-supported channel grew.
And then there's sports. Content is fragmenting everywhere. You'd think that's a nightmare for viewers.
But for them, it's an opportunity. They're basically monetizing our frustration.
Huh. Okay.
We all know that pain,
I
right?
found-
Jumping between 4 different apps just to watch your team. That fragmentation is their opportunity. As sports, especially big stuff like NFL games, moves more into streaming,
Yeah.
viewers desperately need a simpler way in. So their Roku Sports Zone is designed to be that central hub. The best place to watch sports, no matter which app actually has the rights that week. They aggregate it all, making themselves essential again.
Makes sense. And looking even further out, what about shoppable ads? They keep talking about teaching America how to shop on TV. Is that real yet?
They sound pretty bullish,
Yeah.
is the word they used, but also realistic. They admit it's still early days. But they see the potential, using their scale and central position in the living room to eventually connect watching directly to buying, something they're investing in, and they definitely expect it to grow into a real business line eventually.
All right.
But for right now, it's more future potential than current driver.
Got it. Okay, so we walked through the three main strategies. Let's zoom back out to the overall growth numbers. Q3 platform revenue was up 17% year over year, which is solid, but you mentioned if we strip out some noise, it looks even healthier.
It absolutely does. If you pull out political ad spending, which can be lumpy, and the friendly TV business they had.
Mm-hmm.
That growth rate jumps to 19% year over year.
Okay, 19%.
And maybe even more importantly, if you look at their Q4 forecast, the guidance implies another step up in growth. Closer to 21%, actually, once you adjust for those things and this technical accounting standard called ASC 606.
All right, for those of us like me who don't live and breathe accounting standards, what does backing out ASC 606 actually tell us?
Yeah. Simply put, ASC 606 deals with how companies recognize revenue. Taking it out just gives investors a cleaner look at the real operational growth. Like, how is the core business itself growing without those one-off accounting things muddying the comparison year over year?
Okay.
The fact that the core is accelerating towards that 21% mark, that's what's giving management the confidence for their 2026 outlook.
And scale-wise, they're projecting hitting 100 million streaming households in 2026. That number is just staggering.
It really is.
What does that kind of scale mean for ARPU, the average revenue per user?
Well, here's their key point.
Hmm.
They expect ARPU, which, is probably the single most important metric for platform health.
Mm-hmm.
They expect it to grow faster than the number of active accounts.
Faster than accounts, okay.
They believe ARPU can go way higher than it is today, precisely because of those three monetization pillars we talked about. The home screen changes, the AI-powered performance ads, the subscriptions. They're all designed to get more value out of every single user.
So more users and more money from each user.
That's the plan.
Let's quickly touch on M&E media and entertainment advertising. That whole industry has had a rough year, cutting back marketing spend. How is this platform dealing with that pressure?
Yeah, the M&E vertical is definitely still pressured overall, though they did say the movie side, theatrical, is doing okay.
Yeah.
But here's the crucial strategic point. The platform is now less reliant on M&E for its growth than ever before.
Okay.
Because they've diversified where the ad money comes from. Think Amazon DSP, think all those new SMBs from Ads Manager. They actually expect to grow faster than the overall ad market, even with those M&E headwinds. They're not totally dependent on the big studios anymore for revenue growth.
Diversification paying off. Okay, last big topic, data. They always talk about having best-in-class data. Right now, they use it internally, right, to power those ads and personalize things.
Right.
But there's been a lot of chatter, investor questions about maybe licensing that huge pile of first-party viewing data to, like, large language models, the LLMs behind things like Meta's AI or Gemini.
Yeah, that's a hot topic. They confirmed they absolutely know how valuable that data asset is.
Yeah.
Their main focus is still using it themselves to make their own ad business better. But they explicitly said licensing that data to LLMs is an opportunity that's being investigated and considered. They're not actually doing it right now, but they're clearly weighing the potential cash infusion from licensing against the strategic value of keeping that data exclusive to fuel their own ad performance. It's a massive strategic asset, however they decide to use it.
Okay, so wrapping this all up, what does this mean for you, the listener, kind of watching this whole streaming world change? The big picture here seems to be leveraging that incredible scale, half the U.S. market, remember, through three really focused, linked strategies.
Yeah.
They're tuning up the home screen, they're putting the ad business on steroids with AI and these big partnerships, and they're building out subscriptions. It feels like a shift from just gathering users to really fine-tuning the profit engine, all built on that core user experience.
Exactly. And maybe a final thought to leave you with, building on that data point. Think about that unique viewing data they possess, the kind of behavioral insight that companies like Meta and Google are reportedly pouring billions into acquiring or replicating for their AI.
Right.
It raises this really interesting, maybe provocative question. At what point does the potential payoff from licensing that incredibly valuable, unique first-party viewing data to an outside LLM? When does that potentially outweigh the strategic edge you get from keeping it all to yourself, just to make your own ad platform the absolute best performer?
That's a fascinating trade-off. That decision, how they play that data licensing card, could fundamentally change the whole competitive map for these big CTV platforms. It's definitely something we'll be keeping a close eye on as AI continues to weave itself into everything we watch. Thanks for diving deep with us today.